Okay, welcome back. We're still in Chapter 2, and we're going to take a look at the accounting terms that accountants use when they refer to property and financial interests. And again, this worksheet is just something I use in my face-to-face classes, and as I go through the chapter, the students work along with me, and we do it together. Okay, terms that accountants use when they refer to property and financial interests. The first one is assets. This is property that a business owns. Things of value like cash, supplies, equipment, buildings, vehicles, any property that a business owns would be considered an asset. Liabilities are debts or obligations of the business. And anytime we buy something on credit and charge it, we record that amount as a liability. And most liability accounts have the name payable with them. So you'll see accounts payable, where we keep track of all the money we owed to different vendors for things we've charged. You might see later on we'll have notes payable, salaries payable, taxes payable, and those are all debts that we have. Owner's equity is another term, and that's the owner's financial interest. The owner's equity is sometimes called net worth or proprietorship. And basically the owner's equity just tells, how much the owner's worth. So, using these accounting terms, we can use the fundamental accounting equation to show their relationships. And if any two parts are known, the third part can be determined. So the fundamental accounting equation that we're going to use from now on is assets equal liabilities plus owner's equity. And every accounting student anywhere knows that this is the fundamental accounting equation. The assets represents the property we own, and the financial interest, people who have a financial interest in our business are going to be the people we owe money to and the owner. And if we know any two pieces, we can always figure out the third, whether we add or subtract. All right. We're going to take a look also at two other types of accounts and how these affect owner's equity. And the two accounts that we're going to be looking at are revenues and expenses. Now, revenues represent any income that we have, and it's the inflow of money. And we generate revenues from three sources: from the sale of goods or services. In our business, this Carolyn Wells accounting business, we provide a service to our customers, and they pay us for it. We're also going to generate revenue from the use of money. And how can we generate revenue from the use of money? It might be interest income that we earn on investments. And another way that we generate revenue is from the use of property. And you might be thinking, well, how can I generate revenue from property? But think about rent income. Maybe you have a big building, but one room you don't use, and you could rent that out to someone else and generate some revenue that way. Expenses, what we're going to do is look at the outflow of money. And this includes the cost of any materials, labor, supplies, and services that we use to produce the revenue. All right. We're going to look at a few more transactions, including revenue and expenses, and so that'll be in the next video.